how to choose your strikes and your expirations when trading options. Today on the Traders Workshop. Let's get into it after the bell.
Well, I'll have to stand in for Jason and make a comment about the incongruity of the music, because it wouldn't be a show if we didn't get that in there.
Yeah, that's for sure. So no Jason today. He is busy doing other things, slaying dragons somewhere in the options world. So it's just Mark and me today. We are going to talk about strike and expiration selection. And Mark and I have never really talked about this together. So it could be kind of interesting. I don't know.
I did watch the video of you talking about it in your wine cellar.
Oh,
where you compared strike selection to picking a good bottle of wine. So that was a short that was near and dear to my heart.
There you go. See, and don't forget, that's a plug, because we're going to be doing the market wind down Thursdays today, but after the close. That's coming. It's going to be a MyX sponsored event. It's going to be awesome. But mark your calendars, set your DVRs for that baby. It's going to be kind of fun. So stay tuned for that. Probably, what do you think, Mark? Later September launch date?
Yeah, early fall.
Okay, good. We're getting it all set up. Anyway, strikes and expirations. What's your first thought? You have a first thought on this one out of the gate? We're going to share the screen here and put something together and check on some things. Obviously, there's a lot of factors involved, right? Your time horizon is obviously one of them. Where do you place these things relative to the delta, the options, et cetera, right? So what do you want to start? You want to start with strikes first?
30 delta, 30 days.
That's it? Okay.
That's
great
it.
Show. Good to see everybody. So have a great weekend. That's it?
That's all I got.
Okay.
Works every time.
Tell me why.
I think I'm being facetious, of course, but I think that's actually a really good starting point. That like the 30-day, starting from just a time perspective, from an expiration perspective, I think 30 days is an interesting kind of balance between reflecting what's going to happen in the near term. 30 days is kind of, within the short term lens. Everything closer than that is, proximity. But, it also incorporates some more stable. You do get 22 trading days between that time. So it's not going to have the volatility that you see with zero DTEs or whatnot. But so 30 days, I like that as an indicator level. I like that as, just a good check-in to, check that, place on the curve.
Right.
And then the 30 delta is another interesting point. At the money is, of course, a very interesting data point to know. But if you're going to have two more data points beyond just the at the money, beyond your straddle, beyond whatever, your at the money implied vol, you want to look a little bit at where those wings are going, whether it's the 30 delta put, maybe 25 delta, 30 just has a nice ring to it. So that's a good place, I think, to kind of check where that upside, that downside is pricing. So, well, that's not going to be the silver bullet. It's a good place to start.
So are you saying then that using that 30 delta option is a good place to start constructing your option strategy? Now, I'm assuming most people are probably doing some risk-defined spread, like a credit spread, a debit spread. They have an opinion on a stock and they want to do a long call spread, a bull call spread, or a bull put spread, vice versa. So are you saying you start on that 30 delta? Is that a good place to kind of take a peek?
I think it's a good place to kind of check the temperature of the market and see, compare that 30 delta to the at the money. Are we seeing call skew? And like the way that's priced relative to the rest of the curve is going to kind of help inform what kind of spread you want to do. Whether you are bullish on the stock, bearish on the stock, bullish on vol, bearish on vol.
Right.
Understanding, I say those points as a way to contextualize, I guess, what the current markets are pricing.
Right. Okay. That makes sense.
But that might very well end up being the right strike to pick in terms of, the starting point for a spread or whatnot. Like If you're upside bullish, going for something like that, I think is a nice balance between, if you interpret delta as probability of landing in the money at expiration, you got a 30% chance. So,
Right.
framing that in terms of your odds and, opinion,
Sure,
that can be a good starting place too.
Yeah, and I was just going to bring that up about the 30 delta. Essentially representing a 30% chance that option will finish in the money by expiration, right? So I like that too. So I would say that we always looked at the 25 delta. I don't think there's an argument between 30 and 25. I think 30 is great, even though we use 25. The only reason I like 30 a little better because it's getting closer to the 50, which is the at the money. So I do like that. It tends to have a little bit more meat on the bone as opposed to, I know it's all fluff, but it's getting less fluffier in terms of juicy, extrinsic value. So I do love the 30 to 30. Interesting you said 30 days to expiration because that's my honey zone. Happens to be 30 as well. So think of strikes, folks, as your probability channel, and also as what the skew is doing. And we'll see a picture here in a second. So that's where you want to test whether it's a put skew, a call skew, flat skew, that sort of thing. That 30 delta put to 30 delta calls, that relationship can tell you a lot of things, as Mark just mentioned, about is it steep skew, is it flat skew, is it inverted skew, that sort of stuff. That's always nice to know when putting on these kind of spreads, right? Next thing I'd emphasize, and Mark, I'd like to have your opinion on this, and if it matters at all, is I like to look at the expected move using the straddle. And if I have a bullish sort of opinion on a particular stock, I like to see what the expected move is suggesting in my 30-day horizon, and maybe placing the top end of my spread, the better end of my spread up at that top end of the expected move. Any thoughts on that concept at all?
I absolutely love the straddle, right? If you only have one tool in your kit, the straddle is one of the best ways to get kind of a one data point answer for what vol is pricing, what move expectations are in the stock. So,
right.
Little plug for the till. I wrote a great blog called "The Straddle is Your Hammer." That if you have one tool that you could put in your pocket, it would be understanding what the straddle range is.
Right.
And I know plenty of good strategies that will use that. Like you say, it can be a bullish target, but also from the cash secured put side, right? Like that's a great kind of bearish target that you might say, you know what, I'm willing to sell puts beyond the straddle range because that's, less than X chance of that happening. And so, I think if you can have two things, you combine the straddle with some of those pictures of the wings, and you really quickly start to get a picture of, how things are priced relative to your opinion and relative to what type of structure you want to put on.
Exactly. I love it. Okay, good. The other thing I'd say is, we have a lot of zero DTE people out there, right? They're loving trading the zero DTEs. What do you think about that? I know that for me, I'll tell you straight out. For me, I find that I suck at trading zero DTEs. I'm just not good at it. I get too involved in the movements, and I'm like, oh my God, now I got to roll it. Now I got to get out of it. And I don't like it. My time horizon is more of a swing trader. And that's why I love the 30-day. That's some intermediate term, medium, great for swing trades. It gives you time to let your strategy develop. And you can have something go against you in the medium term, the 30-day term, right? And you know what? It might not push you out of it because of your parameters on where you're stopping yourself out. So the spread won't get dramatically different with movement in that 30-day time horizon. It'll change, but it won't get dramatically different, right? So it'll buy you time, which I like, because look, I don't want to play pin the tail on the donkey or play a dart game where I have to get it just right. That's why I don't like butterflies necessarily. I like broken wing butterflies because that's a little, not as sticky. I did a butterfly in Tesla. I don't know. It was a 60-day butterfly, and it went up to my strike within 3 days. Guess what the butterfly did? Nothing.
Early on in that butterfly trade, you're not getting anything for pinning the tail.
You're not getting anything out of it. So look at on the broken wing, I can structure it so that if I get a blowout to the upside or downside, depending on which way I put it, I win. I'm winning. I don't have to play that dart game with a true butterfly. Same with a condor. I can spread out that range a little bit and take advantage of some of that. So my point here is that looking at that expected value move can really help where you put your longs and shorts in some of these spreads, is all I'm saying, right? And I use it all the time. We're going to look at an example in a second. Thoughts, Mark?
Totally. I mean, I think a really important part of that whole strike selection process, expiration selection process, is identifying what kind of strategy you're looking to execute. And you've self-identified as a kind of swing trader, maybe a little bit of momentum in there. And that's great for those medium-term type expiration selections. If you're going for something very short term, you're trading something, less than a week to expiration. That's where you're, starting to dodge the landmines, catching a little bit more premium for it. But, you've got to be much more tactical. Love a bot to do something like that. But it's definitely a distinct trading strategy there. And you're pushing out longer term on, to the extent that you're looking at a hedged equity strategy, or to the extent that you want to have even more down the investment spectrum of, opportunity capture. You're going for the quarterlies. You're going, the 90 days out.
Sure.
Hell, if you're collaring something, you might go a year out. So, identifying what your strategy is really going to determine that.
Yeah, I think those are great points. And I kind of had a little diagram that I drew up prior to the show. Almost word for word what you just said. So the short term are for catalyst events, earnings, news announcements, those kind of things that you expect to happen this day, right? That's your short-term strategy. And you said a week. I always defined it as 10 days and under. Sure. Right? Just a nice round number. That's the short-term world. Okay. Medium term goes out to, beyond the 10 days, probably 20 to 40-ish, give or take. So 30 is right there in the middle. Love the 30-day. And don't forget, for those 30-day options, especially if you are selling things and capturing premium and harvesting theta, that's when it starts kicking in a little bit. You start hearing a crackle at about 30 days. Now, I'm not saying it's melting like a 0 DTE at 30, but it starts to crackle a little bit, starts to melt just a little at 30. So it's a nice zone where some of that longer dated stuff's kind of holding up there. And right around 30, you start seeing it just get a little soft, like when you put butter out from the fridge on the counter for about 15, 20 minutes. Right. So right around there. And then the long term, and I don't want to, deny the long termers. You're an investment. You're investing in the long term. Absolutely nothing wrong with it. If you have a long term vision of Apple or Nvidia, whatever it is, and you want to just be long the underlying, there's lots of things to do with options to, replace stock ownership. If you want, you can do what is it called, Mark? The fig leaf? Is that what they call it? Where you buy a deep high delta call in the leap and you sell covered calls on that call. Okay. I love that play if that's what you want to do in terms of ownership of a name, right? Nothing wrong with it. Just totally different game. Different game.
I even do a little bit of a different version of that sometimes, where I'll pay for a put protection in the long term by selling near-term calls. Same thing where you have like an underlying investment and, rather than completely replacing it. But yes, playing across that term structure as an investor with that horizon allows you to do a lot more to kind of nip and tuck your position. Sure.
And as an example, I did this, when Elon and Trump were buddies and everyone wanted to sell his electric car company down to $280 thereabouts. I'm like, this is ridiculous. I just said to myself, I had an opinion. This is overdone. It's emotional. And I want to be long Tesla. Well, I didn't buy Tesla. I looked at the expected move. I did a big bull call spread. I bought a lower strike, sold a higher strike. Guess where it is today? And I did it at the 30 to 40, day range. And I did as much width in that strike as I thought I could handle relative to the price I had to pay for it, my risk reward. And guess what? It made it to that expected value pretty much. It took it off. Didn't get full value for it because I'm not pinning the tail on the donkey either on that side. And I'm out, right? It was opinion. That's all it was. And I use all these things we're talking about to come up with, those metrics, right? So.
Yep. So you want to hear my pseudo math for why I think the 30-day expiration is also interesting?
I love pseudo math. I use it all the time.
So 30 days to expiration, a month out, we're talking roughly 22 trading days.
Yep.
In statistics and probability, you consider a reasonable sample size n over 20 or so. That, to start making predictions about the population, you want to see n greater than 20. Yep. And it's like a good, it obviously depends like what the sample is, a lot of caveats there. This is pseudo math, but over the course of 20 coin flips, if I think there's a slight bias in that, that's going to materialize over 30 days. I'm going to be wrong sometimes. It's going to zag before it zigs, before everything works out. But like you say, you have time for that to work out. You're making a bet that on average over these 20 different days, it's going to net, go in the direction that you expect. You can make that coin flip 20 times independently in a 0 DTE in the right strategy and like achieve that kind of, probabilistic outcome that way. But, when you're thinking about like a momentum play that, might not happen now, you get enough kind of flips and, with your bias and it starts to work out over 30 days.
Yep. I love it. I agree with that 100% too. And I love the pseudo math part of it. So that's excellent. What do you say you want to go to the screen?
Yeah, let's take a look at the remarks.
Let's take a look at the screen.
The screen's up. Nice.
Yeah. So what I have here, this is Tradier Pro, TradeHawk. I'm in Apple. I don't know. Can you see my mouse moving, Mark?
Yep.
Okay. So, and I don't have a drawing tool on this thing here for some reason. Anyway, we're in Apple. Notice what I chose randomly. Not so randomly. I mean, I looked at it. I'm at 29 days. Huh. What did we just talk about? So it's close enough to 30, right? So I'm in the September 12th expiration. We're not going to talk about implied volatility right now. Maybe we'll get into it. But all I did was choose the at the money, and it's banded by that orangish colored band. It's always there for you. You can't miss it. It always signifies the at the money. In this case, it's about the 230, strike. Okay, and it automatically updates. And when you're looking at the straddle, don't forget it's a straddle. It's not a combo. So what I did is I put 2 buy legs into the ticket. You can put 2 sell legs. It doesn't matter whether you're buying them or selling them to come up with a price. But you can't put a buy and a sell because it'll subtract them. Okay, we want to see the sum of the 2 at the money options, call and put. So the 230 call, I have it in there. The 230 put, I have it in there. It comes out to be 1303 as the price. So that's the midpoint price. You know me, just get close, drop a grenade. It doesn't have to be 1303. Let's call it 13 to make the math easier. So you take $13, you subtract 13 from 230, or 230 minus 13 to get your downside strike, right? So what is that? That's going to be 217, right? Thereabouts. Again, doesn't have to be perfect, so 215 is close enough. And then your upside is 247. Call it 45, even 50. I like to go a little bit more on these things. So that's our expected move here, right? Now, we could analyze skew, whether we're going to do it. Now, if you're super bullish in Apple for whatever reason, I'm not saying I am. So what I would tend to do, and I'm going to remove this, if I'm really bullish, I might put my short strike up at the 250 mark and then make my long strike underneath that. And again, how wide do you make this? Any thoughts on that, Mark, on whether you're doing a 5-point or a 10-point or even a 20-point? Any thoughts on doing those kind of spreads like that, especially in this bullish case?
Kind of simple rule of thumb, and this is intuitive, that the wider that is, your long leg closer to the money, more expensive that's going to be. But you're also probably going to have, realize, you're more likely you've got a higher delta of realizing, some part of that back.
Right.
If you're going further out of the money, where your long leg's further out of the money, there's a big chance that you lose everything, right? And so, we're not talking about sizing here specifically, but you'd probably do different contract quantities if you're going for the small upside call spread, where there's a chance of, never even touching, but if it does, it's, big percentage win overall, compared to the, chance of getting back half your money, with the deeper spread.
Would you ever move this spread up to make the long leg go up to where our expected move is? Do it that way? Does that make any sense ever? Now, and the only reason I say that is because look at the difference in price. We got 68 cents and we got only an 8 delta. Now I'm going to move it back down to where I had it. Okay, we have a $2 price as opposed to 70-cent price. Okay, and we have an 18 delta. Any kind of logic to that play?
I tend to like to put my short strike where I think it's going to go.
That's what I do. I'm with it.
You want it to go to your shorts. That's where maximum value of the spread is.
Yep.
And so if the straddle is a good predictor and that's going to go to that bound, then I want my short there.
Mhm.
Absolutely.
Yeah.
You're going to get a lot more leverage if it does blow out, if
Yep.
you're buying that level, but I tend to like to put my short there.
Yeah. Okay, good. So that's how I would set that up. Now, look, you could also say I'm bullish and I don't want to pay for theta, which I'm doing a little bit here. So what's the opposite part of that? Well, we could go down here and go down to those strikes down below, right? And do one of these and sell a put spread, right? Now we're collecting stuff. Okay. Now don't forget, you got to look at the difference between what you're making by selling this versus what you can make by buying it, and around those same deltas, they should be very similar. It's a matter of, is this skew behaving such that you should be selling the put spread or you should be buying the call spread, right? Thoughts?
I think that's a great throwback to why we want to look at the 30 delta. They're looking at that 30 delta put, looking at that 30 delta call. That's going to help you define whether you want to be selling the put side of the skew or whether you want to be buying the call side of the skew. Interestingly, like in call skew names, like that is getting bid up. And so actually buying that side might make sense, right? Like as a stock replacement strategy, high call skew meaning vol to the upside. Like you might it doesn't necessarily mean you want to sell the calls.
Right. 100%. So I'm just looking at this again. I forgot what I put in here. Okay. Got it. Yeah. So, I mean, I don't think I have a preference. I tend to like to sell things more than I like to buy things. I like to have theta work in my favor. So I may end up selling this. I haven't really looked at the skew in this yet. But I may end up selling that put spread as opposed to buying that call spread in this one. I just don't know what the skew is in Apple at the moment. So I'd have to look at that. And I'd make sure that whatever I did here, so in this case, I can make 77 cents. That's the max I can make by selling this put spread. I'd make sure that my max on buying that call spread is very similar. Okay. If I'm trying to choose between the two. So that's all.
Yep.
Okay.
Last I looked, Apple skew's pretty vanilla.
Is it? Okay. Okay, got it. So I forgot where I put this. I think it was here. Let me see something. Yeah, that's a beauty. So I can make did I bring this in here? Hold on. Sorry. I'm putting this up here. So yeah, I can make 876 to spend $1.23 on a 10 lot, right? So, oh no, that's a 1 lot. My bad. So that's pretty good. And I haven't measured the probabilities yet, but I tend to do that as well. Give a little feel for the probability part of it. So let's just recap real quick. We can go back to us. Some of the things we look at. 30 days is our honey zone, especially for the type of trader I am. And Mark, you sound like you're similar. Unless I have an investment strategy, then I'll look farther out in time. I'm probably not playing in the 10 days and under, the short term. Just generally. I just know I'm not good at it. So me personally, not doing it. Check out that expected move. Use that straddle. It's not exact, folks, but it's pretty good. Again, if you drop the grenade, you'll get close. You'll do your damage. Move along. Place your shorts on those expected moves if you have a directional bias. Yeah. And then maybe if you don't have a directional bias and you think it's kind of sideways, you can flip those sails up, do an iron condor, short iron condor, and you do the same thing. That's where you're going to place your short, or maybe just a little bit above it on both sides, right? Call and put. Now you have a good range to take advantage of that decay and that thing expiring worthless, or at least getting some part of your total max profit off the table in that time frame, right? So those work as well. What else?
One other thing actually that I'll add too is that like kind of a prerequisite to being able to make all these strike selections and expiration selections and put on an iron condor or broken wing butterfly is trading in names that have the granularity of strikes and weekly expirations and monthly expirations that are going to let you pick and choose, right? Like
Yep.
choosing names that have the liquidity to allow you to make these decisions is almost a step before. That, especially when you're just starting out, you want to go for those highly liquid names. And, maybe that implies that there is more efficient pricing, which I think net is a good thing for most traders. But you're going to get tighter spreads. You're going to have more selection opportunities across the gamut. So, even before you get to strikes and expirations, think about a name that's going to have those choices for you.
Yeah, that's a great point. I'm a big fan of lots of strike selection and big liquidity. For retail people, I think it's the place to be. You don't want to get yourself caught in a lifeboat without a paddle and not be able to get back to the harbor, as they say. So be careful on that. All good stuff. Mark, follow him. The Till. I think you sent it to LinkedIn a good bit, right? Tell us, give us some plugs. Give me a plug, or two, or three, or four.
Well, the Till's my blog, talk about options. I got a nice barbecue themed one coming out today. I was inspired by a great barbecue meal last night. So I got the till.substack.com. And then you can check me out at harvestedfinancial.com also, where you'll find details on all the different reports that I offer, but then some of the interesting trading strategies, because we run the gamut. We run short-term strategies. We partner with our friends over at Peakbot to help do some of that. But then we also introduce options into longer-term investment type portfolios. So lots of good stuff you can do, and come check us out.
Awesome. And then this show will be posted on the Tradier Hub YouTube channel. It will also be posted on Smart Options Trader YouTube. And you can get all of our past shows there if you want to go back and rewatch and take some notes. And we'd love for you to follow us on hub.tradier.com. We have a big virtual trading contest coming. It's in the making. It's going to be awesome. It's going to be with live data, even though it's going to be a paper trading environment. And you can win a cash prize of up to $50,000, believe it or not. But you must be a subscriber to hub.tradier.com, and it is free to subscribe to participate. So stay tuned for that. It's going to be coming toward the holidays. We'll be giving more information, and probably right after the new year, we will start launching that contest. Is going to be awesome. And Mark, I know your friends at Peakbot are really involved in that. They're one of the sponsors, so it's going to be really a fun contest. So look for that as well. Cool.
You can trade any expiration in that contest.
Oh yeah, it's going to be great.
Pick your strike, pick any expiration you want.
You can. There's going to be rules though. I mean, there's going to be delta rules, and you're going to have so much option exposure versus just stock exposure. We're going to try to avoid people just buying 10,000 calls in Tesla and hoping they're right. We're going to have it a little more strategic. So it's going to be fun. And anytime you have comments or questions, we love getting those. Send me an email, lex@tradier.com. I love answering emails. And we also do one-on-one online tours and demos and just kind of ask me anything kind of stuff too. And we love that. So anyway, it's Thursday. What else, Mark, before we get to the weekend? Because I know I'm drinking good wine tonight. I promise that's happening.
I actually thought of you when I opened my bottle last night. I had a buddy over before we got barbecue, and had a Comtesse Lalonde, the Pichon Comtesse Lalonde, which I love. Do you prefer the Lalonde or Baron?
I like them both. I have them both too, but as a matter of fact, and I have some oldies of both of those. I think I like Lalonde better.
It's a little softer.
Yeah, Baron's a little can punch you in the face a little bit.
Yep. This was an 05, so
nice.
Yeah, really mellowed out, soft tannins. It was delicious.
Awesome. Well, we're going to be talking about a little wine too on the wind down. I last night had Sina Quanon, which is from Paso Robles, I believe, right? So that's out west, and that's a really kind of culty sort of, wine that for whatever reason I've been on it forever on their list. It was an 09 Grenache, which we had Le Colonial Food last night, which is Vietnamese, French Vietnamese, and it's just perfect. The sommelier had a little sip of it and goes, wow, this is crazy. So
California Rhone is perfect for French Vietnamese.
There you go. I love it. I love it.
Anything else? Great.
Yep. All right. Good. Well, you have a great weekend. Good to see you. Good discussion today. Find it on Tradier Hub if you want to watch it again on the YouTube. And what else, Mark?
Happy trading.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.